switching from the business to a little bit more how they make money, I wanted to cover how they qualify their most important KPI as the ARR. That means annual recurring revenue.
Yes.
And so that's always what I want to see. Recurring revenue sounds like music to my ears. So it means that this is basically an extrapolated annualized basis of the contracts they've already signed with customers. And so it tends to be a leading indicator of future growth because revenue eventually catches up with those contracts. It's extrapolated forward. And so that's really what I focus on every time I open an earnings report from CrowdStrike. I look at ARR. And so the 5-year compound annual growth rate is 97%. So this is where you can use the mind-blown emoji right there. We really see an exponential growth for this business. And even though it will normalize, at least the past 5 years have been amazing. And so virtually all of the revenue is subscription revenue. They also have professional fees when they set up new customers. But first and foremost is a subscription business.
So I have just one question about this ARR. We can see that revenue growth is 94% and then ARR growth is 97%. Can I interpret this number into this for the near future? Our revenue expectation could be higher than 94% growth. Is it correct? Can we say that?
So because here it's over 5 years, it's a little bit misguiding because it depends on the entry point as well, where you may have had a lot of customers that were just signed that created a higher revenue growth early on, even though the starting ARR point was a little bit higher. Basically, revenue is a lagging indicator, meaning ARR is all the contracts signed today, and then revenue slowly catches up as it is recognized over the subsequent 4 quarters.
So we cannot really compare directly, but good news is actually the ARR growth rate is not slowing down comparing to the revenue. So the future business is there.
Yes, but let's say in general, you will see ARR growth being higher than revenue growth. Or lower based on an indicator. So ARR starts slowing down, revenue will slow down eventually and follow through. That's why investors tend to focus first on ARR growth because that's the market is forward looking. Another key item to look at when we look at the earnings reports is the net new ARR. So that's that green part you see here. Basically, they are just announcing what number of ARR that were added this very quarter. So basically new signed, new contracts that were added to an existing base. And again, this is an indicator as well of future growth, just to contextualize whether or not the company is still crushing it, or if it's just the previous 2 quarters that have contributed to a year-over-year growth.
Just out of curiosity, for this kind of a SaaS companies, is a contract usually for annual basis or 2 years, 3 years? Do you have any idea about that?
Yeah, it depends. I look at so many SaaS, sometimes forget which one is over multi-year or over 1 year renewed. So I can't tell you right away for CrowdStrike. What I do know is that they tend to be automatically renewed. And if there is a change in the scope or something like that, they would renegotiate. But usually the prices are clear for existing modules. And what really creates a difference is when a company decides to add a module, so an extra tool, basically, where they would use CrowdStrike, they end up spending more. So that's something to consider here.
I see.
Very briefly, 2 aspects to consider for any SaaS business. Expansion and retention. What a company will call net retention is how much more money are they making over time from existing customers from a year ago, net of churn, net of those that they've lost in the meantime. So 124% was the number for end of 22, and it's still above 120% today. And the other item to consider is the gross retention. That's how many customers do you keep over time. So the maximum is 100% there. And here, CrowdStrike is stellar with 98% gross retention.
That's amazing.
we'll talk about valuation, but when you look at these numbers, you're really investing in an amazing business. There is no question, right?
Yes.
I mentioned the word module a few times. So again, those are the additional individual tools that people can use to add to their toolkit out of the CrowdStrike services they use internally. So for context, what we're seeing here is a ever expanding use of existing customers of CrowdStrike. For example, 4 modules or more, 71% of CrowdStrike customers, that's a 7-point higher than last year. It used to be 64% and now it's 71%. For 5 modules or more, it was 50% a year ago, it's 59% today. They started covering 7 modules or more. That wasn't even a bullet point in their slides a year ago. So they keep having to expand how the increased usage on their platform. I love to see that. One aspect to appreciate is also their market penetration, right? So 65% of the Fortune 100 companies, about half of the Fortune 500, and 15 of the top banks in the US. So of course, that market penetration is also going to create at some point a little bit of a slowdown in customer growth. And of course, we already have a baseline with the net revenue retention that already creates a 20 to 25% revenue growth. And then the normalization will come from the fact that at some point they start to have penetrated the market. I mentioned that green part about ARR additions every quarter. So if we look at the past 5 quarters here that I used to highlight, we can see that the growth has been fairly consistent. There is no clear slowdown, at least all the way up until Q4. This is the sequential growth. And so you can see here the very last quarter was a little bit down from Q4. It was 11%. So that's something I want to highlight because that's something that could make some investors pause and just see, I want to see where that trend is going in terms of sequential ARR growth. Is it going to come down from 11 or are we just going to stabilize? So I wanted to highlight that overall, still very strong growth from an elevated basis. And this will be something to watch. When the management provides an outlook for the company, they've highlighted that they expect to reach 5 billion in annual recurring revenue by 2026. That's a huge aspect to consider because they are very confident they can maintain that new ARR growth for the foreseeable future. And it's not in their best interest to overpromise and underdeliver. Historically, this company has actually underpromised, overdelivered. And so the fact that they are confident about a 5 billion ARR by 2026 is very encouraging to me. Again, bearing in mind that a recessionary environment may challenge this view, and they cannot, just like us, just like the two of us, Charles, management cannot exactly predict the macro environment, right?
Yes, of course.
When looking at the financials, I always like to show you this chart that shows the margin trends. So you can see how 74% is the gross margin has been growing over time. Meanwhile, in orange, you can see sales and marketing costs going slowly down over time. They're at about 38%. That's lower than most SaaS companies that tend to spend half of their revenue on marketing. And here, the blue line, you can see the operating margin. This is a GAAP metric, right? This is including stock-based compensation, everything on it. And so technically, CrowdStrike is not profitable yet, still a negative 5% operating margin in the last quarter, but you can tell that there is a very clear trend here up and to the right, and the company should be profitable on a GAAP basis very soon. How do they do that? They are clearly showing operating leverage. Here, management is showing their margin trend on a non-GAAP basis. So they are excluding SBC. It's not as good of a metric, but it shows that setting aside stock-based compensation, they are clearly improving margin across the board. And on an adjusted basis, they're actually already profitable, 17% operating margin. And so the difference between what I was just showing you and this 17% is the stock-based compensation for the most part. So they are spending less on marketing, less on research and development and G&A in percentage of their revenue over time. Beautiful. We just talked about the potential liquidity crisis, and we want to seek companies that show financial fortitude. So that's exactly what we are seeing here. On the left side, I'm showing the balance sheet, 2.2 billion in cash and short-term investments compared to 700 million in long-term debt. So that's a net cash position of 1.4 billion. So they could have negative cash flow for a while before needing to raise any kind of money. But more importantly, on the right side, I'm showing you the trend, the cash flow trends. So you can see the revenue at the top, 1.6 billion in purple, and the cash flow margins, cash flow from operations and free cash flow are at about 600 million and 500 million respectively. So even though the company is still losing money, it's printing cash because stock-based compensation is a non-cash expense, meaning there is no cash coming out of the bank account. Those are just like equity rewards to employees.
When we talk about the free cash flow, can you explain the mechanism behind it? Because we already know that this company, the operating margin is still negative. But how come the free cash flow is very rich? How does it happen?
Yeah. So when you think about a company's performance, you have the operating income statement that shows really where the performance of the company is, but you also have the free cash flow statement that shows money that comes in and out of their bank account. And some costs have no cash impact. And to give you an example, if a company buys a building or an asset like a car or a building, they're going to amortize it over a few years. And so if I buy a building for $1 million and I amortize it over 5 years, 200,000 every year. Those 200,000 each time they hit the accounting side of things, the operating, the income statement, but it wouldn't hit the free cash flow statement if that building was already bought 5 years ago. So the cash impact is on the first year, and then the accounting impact is over time. And so the biggest difference for CrowdStrike between free cash flow margins and GAAP operating margin is the stock-based compensation that is issued to employee, because they are issuing equity. There is no payment there. It's just equity issuance. That's a negative GAAP accounting impact, but not a cash flow impact.
I see. Okay, wonderful. Thank you.
When looking at valuation, and I want to keep in mind, this is a very volatile market. So by the time people watch this, things could be different. I'm only illustrating here, right? And so what I'm using here is enterprise value. So this is the valuation of the company if you strip out cash and debt, because CrowdStrike has more cash than debt, so that's important to exclude. Yeah. And I compare it to the revenue because, as I just pointed out, CrowdStrike is still losing money, so we cannot really use a PE ratio or anything like that, and that's okay. So when we look at EV to revenue, basically the company is close to the cheapest it's been since going public. 25 times sales. This is the previous time it was at its lowest point was 15 times sales. That was at the bottom in March 2020. But a better metric is the forward EV to revenue, meaning the valuation based on the next 12 months revenue, because it factors, for a company like CrowdStrike that's growing like bonkers, 60% year over year, it gives you a better sense of what's going on. What I like to do is even to look 2 years forward, because you're looking at a subscription business, right, with a lot of guarantees in the predictability of the business, the sustainability. And so the way I think about it is, okay, in 2024, 2 years from now, I'm looking at a company that's valued at 12 times revenue. And again, free cash flow margins are very high. About a third of revenue goes to cash. And so really, CrowdStrike is trading at about 36 times FY24 free cash flow. And so that valuation for a company that by then will grow north of 30%, well north of 30% theoretically, assuming macro conditions are stable. So when you think about it, that means if you buy CrowdStrike today, chances are 2 years from now, it's already an undervalued company. The challenge is, can you deal with the time in between where you don't know, right? The companies that have this kind of profiles, they tend to stay overvalued if you look at trailing metrics, because investors are just buying and paying for the value of the company 2-3 years down the line, because they know that they will get their cash back and create great returns through that. Historically speaking, the company, as I was mentioning, has beaten expectations from Wall Street by about 6% on average. So that can compound over time. And what I was pointing out to, north of 30% growth in 2 years is what Wall Street expects, about mid-30s. Yeah. And so if you consider that the company keeps beating expectations, there is a good sense that you might be looking at an undervalued company 2 years from now. So if you're investing over 5-10 years like me, that's an interesting entry point. If you're investing only for the next 6 months, I really don't know. Because if we see a revenue growth attrition, as I just mentioned, you may be looking at a company that will be just like that, March 2020 down to 15 times sales. And so that's 40% short drawdown from today? That's entirely possible. I like to say that what's a company that is down 90% from its high? It's a company that was already down 80% and that fell another 50%, right? And so you cannot assume that because CrowdStrike is down 40, 50%, it's not going to fall more. It can, and you have to be prepared for that, right? This is from June 25th, so this is a few days old, but I just wanted to show where the company is in terms of rule of 40. This is something I use to look at the quality. It's a snapshot in time, right? So on the left here, I'm using sales growth as the x-axis and operating profit on a GAAP basis for the y-axis. So you can see that CrowdStrike is one of the few winners of the rule of 40, which basically adds up revenue growth and operating profit. Some people use free cash flow margins. The point is to say, is this company growing fast enough that we can look past the losses, right? Because that you could argue that it's safe to invest in future growth if you have the growth that justifies the investment. And here you can see that CrowdStrike looks really pretty with a better growth profile and a better profitability profile at the same time than many other companies. From a valuation standpoint, you can see that there isn't that many companies on the right side of the chart that have a higher multiple. Zscaler is one of them, also a cybersecurity company, Datadog that we previously discussed, and Snowflake. So why is that? Because CrowdStrike is clearly one of the best companies out there in terms of revenue growth, free cash flow margins, and the market is rewarding that. And so again, the way I think about it is, ideally, I want to seize the opportunity to buy CrowdStrike whenever it's on the lower end of its valuation spectrum, which is the case right now. But I always keep in mind that it could fall further. The challenge is that if you say, I'm not going to buy CrowdStrike unless it's trading at 10 times revenue, well, the answer is, unless it's the bottom of the bear market, you're probably not going to see that. Because a company trading at 10 times revenue is a company like Adobe. Adobe grows 20% year over year. So it would make no sense to expect CrowdStrike to trade like that because the quality of the business demands a higher multiple, right? And I know not everybody is comfortable with that, and that's okay, but it's something to consider because always context, right? Evaluation rewards the inherent quality of the business. What are you going to see in your portfolio 2, 3, 4 years down the line? If the quality is there, it will grow into its valuation, meaning the revenue growth is going to be such that the multiple is going to see an attrition naturally, even if the stock goes nowhere. And this is my last slide here. It's just a way to show all the things that we covered and all the criteria I usually look for when I want to make an investment. And that shows you why CrowdStrike is in my portfolio. There's a lot of green tickers here.
It's all ticking the box, yeah?
Yes. That's what I really appreciate about this company. So the financials, all green, growing fast, margins improving, strong balance sheet, and of course, strong margins, unit economics. The products itself shows everything I want to see: large market, optionality, surfing a secular trend in cloud security, and it's the number one company in that field. And of course, management, founder-led, they tend to outperform other stocks. smart backers. We know Tiger Global, Atreides, for example, Gavin Baker is an investor there. So, you're investing with other very smart people. It's a very well-regarded leadership team on Glassdoor, still with skin in the game and a strong track record of releasing new products. So that really encompasses all the ways I look at a company before adding it to my portfolio.
Excellent. So one thing we didn't talk about is actually the cloud revolution. In my opinion, cloud revolution is already happening, but it hasn't completed yet, which means many companies are still with the traditional way of managing their data. Many companies still have a server in their own premise and haven't moved to cloud yet, which means this market could be much bigger in about 5 years' time. So there could be another big opportunity because of that expansion. And what I found amazing is TAM growth, because as you mentioned, CrowdStrike started with the endpoint security market, but every quarter they add a new market opportunity, which means without growing each market, they are already expanding the size of the TAM. And plus, each market is growing because of the cloud the growth. And that at the end of the day, the TAM size is much different comparing to a year ago, 2 years ago. So we are talking about getting bigger and bigger opportunity for this company. And I totally agree. Even though it is a very expensive stock to buy, it could be very attractive, tempting.
It is, yeah. It's, ServiceNow is about $100 billion business, but I look also at Salesforce that's going to be north of 150. And yeah, it doesn't take a huge leap of faith to see CrowdStrike becoming, over time, a $200 billion company. But then it's, again, not a great fit for all investors, because you have to be the kind of investor who is willing to say, I really look forward to see what CrowdStrike looks like, 5 to 10 years down the line, and to ride the uncertainty that comes with those long-term goals, where you need to see that revenue growth still come in, and there's always a risk of under performance for reasons we covered. So I think if you're that kind of investor, really who loves to follow along the story and look at the long-term opportunity, that's where it becomes really a great fit.
Excellent. Do you see any other risks we need to have in mind when we choose to invest in this company?
Yeah, there are many risks, I think. So one of them is the revenue growth attrition. If we have a recession over several quarters, this could happen and the valuation will take a hit. So that's one, that's near term. Longer term, this is a ever evolving environment. And so competition is always a thing, right? If you're in a leader in a market that is very exciting, you're going to have a ton of people competing with you. But there's always this aspect of new entrants. There is a new CrowdStrike out there, maybe that's being founded right now, or maybe it's already, a Cloudflare, a Zscaler that managed to expand also their toolkit in a way where they eat market share away from CrowdStrike. So that's always a possibility. A company like Microsoft, you mentioned, has deep pockets, right? So what if they find a way to have really a tool that supersedes CrowdStrike, and that CrowdStrike from its leader position slowly fades? That's also something that could happen. So we don't know. That's part of the beauty, right? Because they are so greatly positioned right now, based on what we know today, that's not a problem, right? Competition is actually in favor of CrowdStrike, but things can change on a dime. It's the technology space. So being mindful of that is important, I think, to appreciate that it might not be the case over the next 6 months, but down to 5+ years, competitive landscape can turn against you.
Certainly. So hopefully the CrowdStrike will be able to expand their network effort, which means that they will get more customers and more data, and then try to improve the ability and capability of their AI, and then should be easier to compete with the new competitors in the future then.
That is the plan, indeed.
All right, Batlanda, thank you so much for your wonderful presentation. It was very interesting, and also I have to say very tempting to buy this stock. Of course, the older audience has to do their own research and study before they make a final decision. But it was amazing to see a good company with a lot of potentials. Thank you so much for your wonderful insight.
My pleasure. It's always a pleasure chatting with you, Charles.
Great. So hopefully we will see you again in 1 month's time.
Of course. And for your members who want to see the 5 other companies that I cover this month on the best buys now, their CrowdStrike is only one of the 6. So that's something also they can do. I always enjoy sharing those ideas.
Okay. Thank you so much for your time and energy. I will see you in 1 month then.
All right. Take care, Charles.
Okay.
Bye-bye.
Thank you. Bye-bye.